Welcome to Stocks to Watch. I'm Ashley Berry, and today Global One Media is welcoming a very special guest, Richard Carleton, Chief Executive Officer of the Canadian Securities Exchange, or CSE. The CSE has been in operation for 20 years now and offers investors access to a broad selection of growth companies through a liquid, reliable, and regulated trading platform dedicated to entrepreneurship and a leading hub for discourse in the entrepreneurial community. Richard, thank you so much for taking time to speak with us today.
Thank you, Ashley. It's my pleasure.
Sure. So I'd like to start with perhaps what insights you can provide on recent capital flows, particularly in light of the central bank's peak monetary tightening.
Yeah, I think you've actually pointed out the key measure governing behavior, particularly from retail investors. And that's a segment of the market that the Canadian Securities Exchange and marketplaces that serve retail investors in particular are highly dependent on. And we've noted with the increase in the overnight rate, both in Canada, the United States, and internationally, that participation rates have gone down quite dramatically from the highs that we saw in January of 2021 during the pandemic, when stock markets around the world were seeing record levels of turnover. We've regressed to pre-pandemic levels quite significantly over the last several months since the central banks began their increased policy.
So as we look ahead, we're about a month out from 2024. How might markets react to these changes specifically?
Well, I think we're going to see significant decreases in the overnight rate from policymakers in Washington and Ottawa. And we see a significant increase in retail participation as well. Now, the key theme governing the markets, particularly in Canada and Australia, another marketplace that does a lot of work with pre-revenue companies, is in the mining space. And so we are seeing a tremendous amount of smart money, which is backing companies that are looking for the so-called critical or strategic minerals. So zinc, copper, nickel, cobalt, graphite, lithium, the rare earths. We have a long history of supporting the gold and silver and other precious metals exploration marketplace. But over the last couple of years, the vast majority of the new companies coming into the market represent folks that are attempting to address supply chain issues that we believe we're going to be seeing in the coming years as the economy electrifies further.
Yeah, I think that's an excellent point. Thinking about even here in the United States with the protections, the executive orders on the critical precious metals, all of that, very, very important. Let's maybe shift over to the IPOs. Have we seen an increase or decrease in them this year compared to last, and perhaps what factors might be influencing that trend?
Well, we're a little bit off of last year's record numbers. We had 122 new companies join the CSE in 2022. And we'll be around 100 companies this year. And again, I think part of the reason for that, I would say slowdown, but I mean, this is the second or third best year that we've ever had. But again, we are seeing smaller companies and generally speaking, mining exploration companies for, as I mentioned, the so-called strategic minerals that are getting funded and are coming into the marketplace. And again, maybe a little bit less participation from life sciences, technology, cannabis, and other areas that we've been known for over the last 5 to 10 years.
Yes, absolutely. And, obviously we speak with a lot of cannabis companies. Considering the current economic indicators, what stage of the business cycle would you say are we in? And what are the expectations for transitioning into a new phase? You've been around for a while. You have a lot of insight. So we'd love to hear a little bit more about this.
Well, I'm not so sure about the business cycles and so on. My sense is, and as an economic historian and a bit of a history nerd, is that we have very powerful deflationary pressures in the economy, and that's largely driven by investments in technology. And so we saw dramatic decreases in the cost of manufacturing, where we've been able to onshore a lot of activities that were sent abroad, say in the 70s and 80s. And are now back in Canada, the United States, whether it's auto parts manufacturing and a number of other industrial applications. I think generative AI is going to have a profound impact on the delivery of services. And again, is that going to mean more jobs, or I'm afraid there'll be a lot of jobs that will be lost, but there'll be a lot of new jobs created. But overall, as I say, the impact, I believe, on the overall economic situation is deflationary. And so I see that the policymakers are, even though they're talking about higher for longer and things like that, I don't buy into that thesis at all. I think interest rates may not go back to zero anytime soon. But as I say, going into the election cycle in the United States, we're probably on a similar trajectory in Canada. I just don't see a high interest rate policy continuing for very much longer.
Really interesting that you mentioned the generative AI. I mean, it's like the biggest hot topic. So, where do you see us going forward with that? I mean, do you think it's really going to have a strong impact on pretty much everything we do, especially with the markets?
Well, it already is. I mean, again, I'm a lawyer by profession, and I see all sorts of due diligence activities, for example, in corporate securities practice, which are being done by knowledgeable robots, and not by teams of young lawyers. That was the case maybe 15, 20 years ago, and that has a significant impact on costs. It has and the way that you deliver service, and really ultimately what it winds up in is focusing on where your real value add is as any kind of service provider, and that goes for accountants, financial professionals, lawyers, and other folks. And as I say, I see the opportunity to take significant cost and effort, human cost and effort, out of the equation and significantly increase the level of service without commensurate increase in cost.
So perhaps you could share some compelling issuer stories and key insights for investors.
Well, as you know, as the exchange CEO, I have to love all of my children equally. So I'm always reluctant to single out a particular story. But what I will say is this. When we talk to, in particular, our folks in the mining space, they, as I mentioned, have been coming into the market in vast numbers, scores of companies that are backed by, as I say, very, very sophisticated investors who understand the mining exploration and mining development game extremely well. And they back these companies, but they've come into the market at a difficult time. And so they're not seeing a lot of secondary market liquidity or price appreciation as these companies report positive results. Because the state of the art is way better now than it used to be as a result of applications of various technical capabilities and supercomputing and analytics and so on. And the risks inherent in mining exploration really aren't what they were a generation ago. So what I would say to retail investors is, and again, many of your viewers may not be experienced at all in the mining exploration space, but there is a generational wealth opportunity here, because we know one thing for sure. We're going to be using a lot more copper, a lot more nickel, a lot more graphite, a lot more lithium in pretty short order, 3 to 5 to 8 years, as we build out these battery plants, as we increase the production of electric vehicles, as more and more truck transportation moves to electric vehicles and so on. And that copper's got to come from somewhere. And we have not been opening new copper mines, new nickel mines now for a while. And so, as I say, there will be a significant impact on the price of these commodities, I think, as we begin to draw down the existing supply chain. And of course, and people are also looking, of course, for projects that are located in Canada, in the United States, in Australia, the so-called nearshoring or friendshoring, politically reliable jurisdictions that reduce the risk associated with having your supply chain tied up with these different jurisdictions. So, as I say, I think investors should take a close look at a number of these companies, because I think they're going to do really well, and they are deeply underappreciated in the public markets as we speak.
So I want to get into this. We've heard concerns from several CEOs about the impact of naked short selling on market value. So perhaps maybe you could shed some light on this issue and the actions taken by the Canadian Securities Exchange.
So as the regulation of short selling is actually done by the independent market regulator, and they carry on those activities on behalf of all of the exchanges operating in Canada. So for us to unilaterally do one thing or the other in our rule set, for example, for example, we couldn't choose to reinstitute the downtick test. There, I gave you some inside baseball just for a second, but the reality is we can't act independently. Now, we are aware, of course, of the concerns of really the key users of their service. There, as you say, there's a significant number of folks in the industry that believe that there is a problem associated with short selling in the junior capital markets in particular. So we have been working with the market regulator and our peers at the other exchanges to help to try and provide the regulator with better tools to identify when abusive short selling is taking place. And we think we've come up with some pretty good indicators. And again, I'm reluctant to get into the deep inside baseball again, but we're seeing instances of, for example, delayed delivery in the clearing and settlement system. So if somebody shorts a stock, of course, they have to deliver the stock against that sale on T+2, according to the normal conventions of the securities industry in Canada, the United States. What we are seeing is that for a lot of, especially large volume trades in junior companies, that delivery is actually happening significantly later, in some cases weeks or months after the original short sale is declared. Now, they can do that with the agreement of the counterparty, the party that's expecting to receive the stock. Now, in the United States, under those circumstances, if the stock doesn't show up on T+2, there's a mandatory so-called buy-in. And that's where the clearinghouse basically says to the rest of the marketplace, this guy didn't show up with the stock they were supposed to. They're going to have to basically pay a premium to cover that short to acquire the stock in the open market, or actually from market participants or other market participants. And as a result, there's the feeling is, the belief is that there is less opportunity for profitable naked short selling in the United States than in Canada. As I say, in Canada, the buy-in is optional. So we're working with the regulators to change that and to look at how we basically make it more expensive, more punitive, in effect, for people that more risky, for people that are conducting short sales, particularly, as I say, in the junior capital space. The other concern we have in Canada is the markets aren't as transparent for many investors, so that we do not have a single place where you can go to get all of the trades and quotes. Instead, we have 13 different marketplaces that are competing for trading activity. And you have to, in fact, negotiate with each one of the individual marketplaces to see all of that trading activity. So if I'm a CEO of a company and that trading activity is taking place away from the market that I'm listed, I probably can't see it. Like I probably haven't subscribed to the right service in order to be able to see it. Well, it's human nature. And entirely reasonable to assume if you can't see it, I don't like it. And so, so we're working again with the regulators and with our colleagues at the other marketplaces to improve access and transparency of the data that individual investors and professional investors can see with respect to all of the trading activity that takes place in Canada.
Fantastic. Really positive also to hear that you're improving really the level of accountability when you think about it, which I think is just paramount. Any key observations you have about the Canadian investment landscape that our viewers should be aware of, Richard?
Well, I think I've really spoken about the my passion for the mining space and the opportunities I believe that there are for investors to earn significant returns from investment in the space. And really that is, again, it's been one of the key areas of our focus for the last couple of years. We continue to work closely with the cannabis industry. And again, we were the exchange that agreed to list the US players back in 2016 and 2017 in particular. And again, similarly, those companies have not seen a lot of love from the marketplace for a while
Right.
because investors have been disappointed by the progress or lack thereof towards legalization or rescheduling at the federal level in the United States. Even, of course, tax measures, which are extremely punitive for cannabis companies, seem to be getting held up as far as looking at those regulations. But that said, even with all of the hurdles, you have a number of companies that have done really well in terms of expanding their footprint, building brands, growing sales. So we've got companies that are selling well over $1 billion annually, top line, that are basically staking out important pieces of real estate in this consumer packaged goods market. And again, I think there's some interesting opportunities for the investor world there too.
And I'm sure very appreciative of your support. Richard, I have a question. Many of our viewers, most of our viewers, millennials, Gen Z, you said you may know some millennials yourself. Maybe you could just give them a little bit of advice, or without giving insider trading information, but, what would you say to our viewing audience about, the Canadian Securities Exchange, about investing in companies? I know you're saying that mining is really hot, very important for you. What's your last piece of advice for our viewers?
Well, there's that beautiful line from Thomas Fisher that says, market timing doesn't matter, but time in the market does. And so one of the things that we know is that the longer you are invested and in a position to take advantage of the compounding opportunities of capital growth. I mean, Warren Buffett, when he discovered the benefits of compound interest, he said, I think it should be illegal. It's so powerful. It's so the point here is that if you're younger, you have so much more time than many people who didn't begin investing until, say, they were in their 40s or early 50s and kind of looking at retirement going, oh my God, I've got to get my act together here. If you're in a position to put a few bucks away, it doesn't have to be a lot. But start and get in the market, because we know that overall in Canada, the United States, the markets are going to compound annually at 6 to 8%. Well, if you could do that math on an annual basis, you're starting in your 20s, you have an opportunity to build a significant portfolio before you're, in your late 40s, early 50s even. And so, as I say, I think that, rather than pointing to individual story or individual industry or whatever, because, I don't know. But what I do know is that if you are there and investing and staying in the market and not losing your mind every time there's a sudden sell-off or a sudden peak and all of this stuff, but stay in, that has enormous power in terms of wealth creation for individual investors.
Such sage advice. Richard Carleton, thank you so much. Chief Executive Officer of the Canadian Securities Exchange, joining us here on Stocks to Watch. What a treat it was to speak with you. Thank you. We'll see you soon.
Thank you very much, Ashley. It was a pleasure.